September 16th, 1992, a day that went down in financial history as Black Wednesday. It was the day one man, a speculator named George Soros, earned the title, the man who broke the Bank of England. But is that story true? Can one person really bring a sovereign nation's bank to its knees? The answer is far more complex and fascinating. This isn't just a story about a legendary trade. It's a powerful case study in how the global financial markets truly work. We're going to peel back the layers of this event to understand that the biggest market moves aren't just about reading charts. They're about understanding the deep, powerful currents of economics, politics, and human psychology. To understand the trade, you first need to understand the trap the United Kingdom had walked into. It was called the European Exchange Rate Mechanism, or ERM. Created in 1979, the ERM's purpose was to stabilize exchange rates across Europe, making trade easier and laying the groundwork for what would eventually become the euro. The system worked by pegging member currencies to the powerful German Deutschmark, which acted as the anchor. Think of it like a group of boats tethered to a large ship. Each currency was allowed to float within a narrow 6% range or band. If a currency like the British pound started to fall towards the bottom of that band, its central bank was obligated to step in and defend its value. The UK had resisted joining for a decade, with Prime Minister Margaret Thatcher famously calling it a financial straitjacket. But under intense political pressure, Britain finally joined the ERM in October 1990 at a rate many believed was significantly overvalued. This decision created a massive economic contradiction. Germany, following its historic reunification, was booming and worried about inflation. To control it, its central bank, the Bundesbank, had hiked interest rates. But the UK's economy was in a completely different place. It was stuck in a painful recession. From 1990 to 1992, its GDP growth averaged negative 0.2%, and unemployment had climbed from 7.1% to nearly 10%. The textbook response to a recession is to cut interest rates to make borrowing cheaper and stimulate the economy. But Britain couldn't. This brings us to a core concept in international finance called the impossible trinity. Think of it like a menu, where a country can only pick two of three options: a fixed exchange rate, the free movement of money, and an independent monetary policy to set its own interest rates. By joining the ERM, the UK had chosen a fixed exchange rate and a free flow of capital. This meant it had to give up its ability to set interest rates for its own needs. It was forced to keep its rates artificially high, around 10%, to match Germany's and keep the pound's value up. This was the fundamental, unsustainable weakness that speculators were about to exploit. Enter George Soros and his quantum fund. While Soros is the name that history remembers, the real architect of this trade was his chief portfolio manager, Stanley Druckenmiller. Druckenmiller had identified the fatal weakness in Britain's position. The pound was overvalued, and the high interest rates needed to defend it were choking the economy. His thesis was brutally simple: this couldn't last. In August 1992, he began quietly building a short position, starting with about $1.5 billion against the pound. Soros's role was different, but critical. He brought scale and conviction. When Druckenmiller pitched the trade, Soros wasn't unhappy with the idea. He was unhappy with its size. He saw the odds stacked overwhelmingly in their favor. If they were wrong, the downside was limited. But if they were right, the payoff could be enormous. That's when Soros famously told Druckenmiller, "Go for the jugular." This confidence came from Soros's unique philosophy, the theory of reflexivity. Most investors see the market like a thermometer, just measuring the health of the economy. Soros saw it more like a thermostat, capable of influencing the very conditions it measures. In his view, markets don't just reflect reality, they shape reality. Perceptions influence actions, and those actions feed back into fundamentals. So Soros knew a bet of sufficient size wouldn't just predict the pound's fall, it could help cause it. By selling billions of pounds, the quantum fund could trigger the very crisis it was betting on. Other traders would see the move, pile in, and the peg would unravel, proving Soros's thesis in real time. So how did the trade actually work? It was a short position. Let me explain. Imagine you borrow a rare comic book that you believe is about to be reprinted, which will make it much less valuable. You borrow it, immediately sell it for $100, and wait. When the reprint happens and the price drops to $20, you buy it back, return the comic book to the lender, and you've pocketed the $80 difference. Soros did this, but with billions of British pounds. The quantum fund borrowed pounds, immediately sold them for stronger currencies like the German mark, and waited for the value to collapse. Now, how was this even possible? In the early 1990s, the foreign exchange market was a massive, decentralized network of banks and financial institutions trading currencies around the clock. The daily turnover was frequently over $1 trillion. Soros's fund scaled its bet up to a staggering $10 billion, using financial tools like options and futures to gain leverage, meaning they could control a huge position with a relatively smaller amount of capital. And they weren't alone. Other major investors saw the same weakness, creating a pack of wolves, all selling the pound. This wave of selling needed one final push. That catalyst came on September 15th, from an interview with the president of Germany's central bank, Helmut Schlesinger. He hinted that a realignment of currencies might be needed, suggesting Germany wouldn't endlessly prop up the pound. For Soros, Druckenmiller, and others, the message was crystal clear. For the markets, it was the smoking gun. Confidence collapsed. The political will to defend the pound was evaporating, and the full-scale attack was about to begin. On the morning of Black Wednesday, the selling began as a flood and quickly turned into a tidal wave. The Bank of England charged in, buying pounds in a desperate attempt to hold the line. But it was like trying to stop a hurricane with an umbrella. And it wasn't just hedge funds. Corporations and global investors with exposure to sterling rushed to get out too, adding fuel to the avalanche. At 10:30 a.m., the government played its first card, a shock interest rate hike from 10% to 12%. The idea was simple: make it expensive to short the pound and lure investors back. But instead of restoring confidence, the move screamed desperation. The selling didn't slow. If anything, it accelerated. The Bank of England was now torching its reserves at a rate of nearly £2 billion an hour. Then came the second announcement. Interest rates would soar again to an eye-watering 15%. But the market called their bluff. Everyone knew a recession hit Britain couldn't survive rates that high for long. The wolves kept selling. By evening, the battle was lost. With reserves depleted and credibility shattered, Chancellor Norman Lamont stepped out at 7 p.m. to announce Britain's withdrawal from the ERM. The dam had broken. In the weeks that followed, the pound collapsed, falling 15% against the Deutschmark and 25% against the US dollar. The so-called financial straitjacket had finally snapped. For George Soros and the Quantum Fund, it was an immense victory. The fund made a profit estimated to be between $1 and $2 billion. The British Treasury, in its failed defense, lost an estimated $3.3 billion of taxpayer money. The event was a national humiliation. But here's the ironic twist. In the years that followed, many began referring to the crisis not as Black Wednesday, but as Golden Wednesday. Why? Because being forced out of that financial straitjacket was a blessing in disguise. Freed from the need to match Germany's high interest rates, the Bank of England could finally do what the British economy needed. It cut interest rates dramatically. This helped end the recession and kick-started a period of 16 consecutive years of economic expansion with low inflation. The most profound legacy was that the crisis forced the UK to abandon fixed exchange rates and adopt a new framework called inflation targeting, which ultimately led to the Bank of England gaining operational independence in 1997. So did George Soros break the Bank of England? Not exactly. He didn't create the weakness. The British economy was already strapped into an unsustainable economic mechanism. What Soros and Druckenmiller did was recognize that fundamental imbalance better than anyone else. They understood the economic pressures, the political fragility, and the market psychology at play. And using the philosophy of reflexivity, they acted with such overwhelming force and conviction that their bet helped catalyze a crisis that was bound to happen anyway. It's a powerful reminder that in the world of global finance, the biggest wins come not from predicting the future, but from deeply understanding the unsustainable realities of the present.